Hello and welcome to the Kingsview Wealth Management Q3 Portfolio Review and Investment Outlook. I'm Scott Martin, Chief Investment Officer of Kingsview Wealth Management and Portfolio Manager at Kingsview Investment Management. Joining me today, familiar face again, Paul. We're doing this quite often now, it seems like. Paul Nolte, of course, folks, who is Senior Vice President and Portfolio Manager at Kingsview Investment Management. Paul, thanks for taking some time out of your busy schedule today to join us and kind of review and maybe outlook a little bit some of the markets, economic data, and things that we look at on a day-to-day basis here at Kingsview in Chicago. Speaking of things, given that we're already through the end of Q3 now, moving into Q4, taping this just about, say, early to mid-October, feeling a little bit of crispness in the air, if I may say. Football season has started. So given that we've had the fall season show some signs, talk about, actually, Paul, maybe just leading off here, some of the rise that has happened, but certainly also some of the falls that we've seen in some of the markets, and also the falls maybe in yields too.
It's been an interesting quarter. So to kind of review the third quarter, it was a roller coaster ride ending pretty much where we started, much like most roller coasters do. The markets were up about 1.5%, but what was interesting is bonds did much better. The concerns haven't gone away. We still have China. We still have the trade issues. We have the Fed that are cutting interest rates. We have worries about the U.S. economy. And we have political goings on with now talk of impeachment. All of those things continue to roil the markets on a daily basis. But when we take a look at it over the course of the quarter, we're pretty much right back where we started from. And I know in talking to a lot of clients, a lot of concerns more around the politics than the economy. So the discussion is always about, what about this, what about that, the Democrats, the Republicans, et cetera. But if you look at the economy, we're slowing down. We're not going into a recession as of yet, but we are slowing down, and we're in a much better place than many international economies. Part of the reason why our interest rates are a little higher, and part of the reason why the dollar is a little bit stronger here. Yeah. So those are some of the things that have been going on that we'd take a look at here.
You constructed a nice proverbial wall of worry there, and you're right. It's certainly something that's been on the minds, as you mentioned, of our advisors, our clients, certainly on the mind of our investment committee, which, as you know, Paul, and some of you know, meets every 2 weeks throughout the month. So those are topics that come up very, very often when it comes to just the goings-on around the world. And might as well just throw impeachment out of there. We don't want to go there probably today, just because who knows what's going to happen with that stuff. It's crazy politics in D.C. as usual. But with respect to some of the other things you mentioned, I mean, geopolitics, issues with Brexit, and I think really that still remaining to be the elephant in the room, Paul, even this morning now that we've got good news on China trade, as we recorded this, pushing up the S&P about 25 points. Let's talk a little bit, or maybe update a little bit on the trade talks goings on or not goings on with China.
Do you got a quarter?
We got to flip it 100 times.
That's about what's been going on. So yesterday is a perfect example. Things didn't look so good on trade. We were talking a little tough. China was talking a little tough. Markets are down 300 points. Today, we've extended an olive branch. China's extended an olive branch. We're up 200 points.
Pretty standard.
But we're nowhere near or anywhere closer or any further away, for that matter, of any trade deal. And our contention has been that even if they signed a deal today, the economic impact is not going to be seen for at least 9 months. So we are going to be suffering through, I think, some of the residual impacts of the tariffs so far. And we've already imposed some tariffs on Europe, on some wine, et cetera. So we're not done. Yeah, unfortunately, we're not done with tariffs. And so, again, it's going to be the news of the day, and that's what's going to move the markets on a daily basis.
And doesn't it feel like I mean, you said it well, doesn't it feel like we're getting into that tariff war scenario now versus everyone? I mean, Europe, like you mentioned, the China situation is one. I agree with you, and we talked about this at the latest investment committee meeting just some days ago. The tariff issues with China, even if they are slightly resolved or seemingly going to be trending in a better direction, it doesn't guarantee anything when it comes to China's compliance and or even a market reaction that can be sustained. Because I think one thing that's going to be huge, Paul, leading into the next several weeks is earnings season. And you've got a lot of companies that are going to start coming out, both in tech, industrials, and so forth, cyclical names too, that are going to be revealing the impacts. Because I think now you're going to see the true impact of the tariff wars and the strife that it's causing these businesses when it comes to investment, when it comes to spending. Talk to me a little bit about how we're looking at earnings season coming up here now that we're getting going into earnings season and how the trade stuff may affect it.
It's flat. When we take a look at the earnings this year versus last year,
Tough
even
comps,
last quarter,
yeah.
it's pretty much flat. We're 2, maybe 4% higher than we were the same period a year ago. So again, and that's part of the reason why the S&P 500 is not very far away from where it was a year ago. So we're not getting that earnings follow through. We are getting companies that are talking about tariffs and the impact. We heard it from FedEx. We've heard it from technology companies. We're hearing it from a variety of industries. And so those are the things that we're going to be looking for here. And part of the reason why I think the Fed is concerned, if we take a look at what the minutes had to say, they released them today, but also some of the discussions on the what I call the rubber chicken circuit, as the Fed officials get out and start talking of their book, if you will, and what they're looking at. And they're concerned about tariffs having an impact here on the U.S. As well as slowing the economy. So we're looking at slower growth overall. We're looking at slower earnings growth, if you will. And so it makes it a little bit more difficult to start to find good names selling at very cheap prices here, because we're looking at the revenue, we're looking at the cash flow and the impact of the cash flow and what that means for companies over a long-term basis.
Yeah.
So it becomes a little bit harder to find those true gems that might be hanging in the weeds.
Valuation is very important when we look at earnings, debt to equity ratios. You mentioned the free cash flow bases that we look at when it looks when we put those into, say, portfolio names and portfolio analysis that Kingsview Investment Management does here in Chicago, because I think that's really where the rubber's going to meet the road, Paul. Is I think it's this earnings season report that's coming up here, or the reports that are coming that you mentioned. And it's funny because it depends on who you look at or what estimates that you're going to take into consideration as to whether we're going to be flat, or like you said, maybe, when I agree with you, a couple hundred basis points to the positive side in earnings growth. Not a ton to write home about, but guidance too is going to be something concerning, in my opinion, with respect to these companies now have to face up or fess up to a tough trade environment and, frankly, a global slowing economy.
Yeah, and what plays into that is the reversal from the Fed at the beginning of the year. When they started cutting rates, and they're talking about cutting it again in October, the expectations are about 80% that they're going to do it again in October. Companies' reactions to that are important. And what they're doing is, as they've been doing over the last 5 or 6 years in the zero interest rate environment, borrowing money, buying back stock. So even though earnings at the net income level are pretty flat, on the earnings per share basis, we're seeing that growth because the share count has come down, and it's come on down for a lot of companies. So top line, very important, pretty flat, maybe down a little bit. Net income flat to maybe up a little bit, and then the earnings per share because of the stock buybacks. And that's what's helping the market stay where it is.
Right. Otherwise known as maybe creative capital structuring, let's say, on the balance sheet. And hand in hand, in our opinion, at Kingsview Investment Management with earnings season is certainly economic data. And let's talk a little bit about some of the data points that we focus on very heavily, whether it's jobs, GDP, CPI, manufacturing numbers, service sector numbers. How have those looked over, say, coming into the end of the third quarter, and how are they looking as we go into Q4, and how they affect our investment modeling?
They've been looking weak, and as I mentioned, they're not at recessionary levels. When you look at manufacturing is down from below 50, and that's the on-off switch, if you will. So it's in contraction, and it's the same around the world. So manufacturing globally is not doing so well. Services continue to do fine. And when you look at a lot of the economic data, where we're going to be relying on the consumer health is still very, very good here.
70% of the economy too, so they should be, hopefully they're doing well.
Well, when you look at wage growth, it's still 3% plus. The unemployment rate, 50-year lows. Weekly jobless claims, 50-year lows. So there's jobs out there, people are making money.
7 million jobs open that are unfilled, they're looking for somebody to fill them, and we don't have enough workers to even fill them to some degree.
And that's part of the reason why, again, we got the consumer that's really going to be the backbone of this. And as long as the consumer feels confident about things, so again, kind of the sentiment numbers, we should be okay. But that's really where we're going to be looking at going forward. So we're going to be relying on the services, we're going to be relying on the consumer. And again, we're not seeing recession right away, but it's something that we're a little bit concerned about, certainly as we slow down, as the global economy slows down.
I agree, and your points on the consumer are very prescient, because that's been a real key to, I think, some of the portfolio's performance this year, is the focus on the consumer names and being able to parse out some of the weak and strong spots in the consumer names and in the consumer sectors to kind of allow us to at least have some exposure to some of the names that have taken advantage of exactly what you talked about, which was a strong consumer, good spending in areas on luxury goods, things like that, low interest rates, fortifying home buying practices, certainly from the consumer. So those things have all been good. But one thing that still I think remains a little bit questionable is the Fed. As we kind of tend to finish up this video note here, I think the third kind of big piece in the room, or the third elephant, if we could, next to the consumer and say the trade stuff, is the Federal Reserve and what they're going to do, both, Paul, at the end of this month as we go into almost a Halloween meeting. I think it's October 30th, so that could be a scary meeting right before the end of the month here, as well as the end of the year, where maybe the market might want 2 rate cuts out of the Fed before the end of the year. I mean, what are we looking at from the investment committee standpoint with respect to that outlook?
Well, right now the expectation, certainly as we mentioned before, is an 80% chance they're going to cut in October and a 75% chance or better that they're going to cut at least 25 basis points before the end of the year. But here's the key to all of this. The interest rate cuts are not going to solve trade. And we've been in a zero interest rate environment since 2009. We did not see dynamic economic growth. We didn't see inflation pick up over 2%. We're in a much different economy and a different situation globally than
Negative
ever
interest
before.
rates everywhere, pretty much. I mean, what, 16, 17 trillion dollars of bonds and negative interest rates.
Right.
Deflationary.
Oh, absolutely. And that's that's the Fed's biggest worry here is deflation. And so, again, what they're looking at is, I think, a different world where interest rates, even if we cut interest rates, it does not necessarily automatically translate to higher economic growth, higher inflation. But a couple things that we will be watching is certainly employment and wage growth, because I think those are going to be more the seeds of future inflation if we get it. And something that bears watching as we get into
in future
next
growth,
year.
and we all want to see that stuff, and I think the market is relying on those things. But in the meantime, I think it's fair to say we should expect more volatility, more very headline-driven markets. So it's definitely something to be careful and aware of as you position portfolios here, certainly as we do our positioning here at Kingsview Investment Management, taking very much care when it comes to watching these data points and the effects they have on the markets.
And not be too scared out of positions because of headlines. So again, going back
Don't
to that.
Don't be too scared out or scared in. The FOMO, the fear of missing out, as well as the fear of maybe missing in.
Just wait, it'll change.
Great stuff. Well, Paul, as usual, you tie things up in a very neat package and put a pretty bow on it. So thank you very much for that aspect, Paul, and that insight. And thank you for joining us. If you have any additional questions or comments on what you heard today, please reach out to your investment advisor or find more information on kingsview.com.